probably 7 or 8 years ago that I took on that role that you're doing, Christina, and said, hey, how can we do this that we're doing all over the United States? Just a quick background. I appreciate all of y'all's background in real estate and W-2 and adding layers onto what you're doing. I started out as a store manager, and then I ended up as a franchise owner, and I did that for 15 years. Really understood franchising from a business perspective, but what I lacked was mindset. I actually, Christina, wish I had met you 27 years ago, although I might not be where I am today had I done that. And what happened for me is in 2008, when the stock market crashed, I found myself out of business. I found myself $50,000 in debt and asking two questions. One, what am I going to do when I grow up? And two, who didn't teach me about money? And I was a little like mad about it. And what I recognized was that I lacked education. So Christina, I'm right in there with you, sharing this knowledge and this understanding that there's education out there. And as I delved into, I accidentally found myself in a financial world and in a consulting business, learning and then recognizing that, wow, my inner engineer, so I started school as an engineer, couldn't get past calculus. So any of you who did, thank you, I could not. It was like taking Chinese for me, and I did not make it out of calculus. And so I went the sales route. I found out I really enjoyed people. I really enjoyed teaching, and those skills all combined about a decade ago. And I found myself asking a question, which some of you may have asked. And that question is, really, where does life insurance fit with saving, investing money? And what I want to do is, there's two probably big pieces in my world that I want to share. Number one, I'm going to take a little cover off the watch, and I'm going to put some pieces on the table, and I'm going to point out some of those pieces of the watch to you. My intention is not to overwhelm you, but to give you an understanding from behind the scenes of why it works and how it works. And if there's a question that comes up for somebody, for one of you while you're here, will you please write it down, put it in the chat? And I would invite you, if you're a note taker, write down that one or two really big things where you're like, wait a minute, I didn't know that you could do that. Like, even just with the title, life insurance annuities as an investment grade instrument. So the first idea that I want to share with you is this idea that life insurance agents aren't all created equal. And what I mean by that is this. What I've learned is your regular life insurance person is focused on offering a life insurance death benefit, and that's the focus. And so when you come to them and say, hey, I have $10,000, $50,000, $100,000, what they might do is say, how big of a life insurance umbrella can I get you? There's a tax code called 7702 that was put in place by the wealthy at the behest of the tax guides and the US government to allow a life insurance umbrella to create an investment grade account. So first idea. When you're building a life insurance policy, there's two ways to do it. Number one is you can build a very small life insurance umbrella, so a very small amount of money for the life insurance umbrella, and then all of this room and space, you get to add extra money to the account. Or, as it happens often, what will happen is the life insurance agent will take all of that money and buy you a whole lot of life insurance, and you'll have a small little space to put the investment. This is a key piece that a life insurance agent may not always tell you about. But I want to start there because this is the number one reason that if you have ever heard, don't put investment money or savings, don't put dollars into a life insurance policy, this is why. It's because the person building the policy got you too much life insurance. The goal, number one, is to have the smallest amount of life insurance umbrella possible. So I'm going to build on these pieces. The second thing that happens is that when we go and we say, hey, I would like to have a life insurance umbrella policy, or a cash value, Napoleon used a word, a whole life policy, or a cash value, or a permanent life insurance policy. What happens is that that life insurance umbrella, the goal, if we're using it for cash value growth, the goal is to have as small of an umbrella as possible. That's the note. Second piece, there are two kinds of life insurance policies and two kinds of annuities in the marketplace. There is a fixed index life insurance, and there's a variable life insurance. And I'm going to build on this idea as we talk, but fixed index means, if you're taking notes, can't lose your money, can't go backwards, get some of the upside. Variable means the money is getting invested in mutual funds. That means loss is present. And you could put money in a variable life insurance policy or a variable annuity and lose money. When I first got started, these were the two biggest questions that I came up against, and I was like, how come this just isn't talked about? If anybody's ever Googled anything about life insurance as an investment or annuities as an investment, all of those things get lumped into one pile called variable instruments or variable indexed or variable life insurance. And if you've ever looked at variable products, they are awesome as long as the stock market's going up. But as soon as the stock market goes down, they lose money a little faster than the stock market. So it's a piece to understand. It's an important question to ask when you're sitting with somebody or as you're diving into learning about it. Okay. There's a couple of components that make permanent life insurance or cash value or whole life insurance as an investment grade instrument work. And that first one is indexing. Some keys that I'm leading us into is I'm going to talk today about arbitrage. I'm going to talk about being able to put money in a life insurance policy. I'm going to do it like this. This instrument that we're talking about today is called a tax-free index account. The tax-free index account, the way that it works, number one, is every dollar that you deposit into this account grows non-taxable. That means that your 1 doubles to 2, your 2 doubles to 4, your 4 doubles to 8. You don't pay tax while the money grows. And when money comes out of a tax-free indexed account, also known as cash value life insurance, permanent life insurance, whole life insurance, the money comes out of the account tax-free. So question, with a raise of hand or tweak of an eyebrow, have you ever had an investment, made some money on it, and then had to pay tax on the investment, only then to have the money come back to you and then go put it in another investment and have to pay tax on the gain again? I see that. Thank you. One of the pieces that Christine and I resonate around is that when we use a tax-free index account, there's a part of tax sheltering and a part of arbitrage that's going to allow us to limit or move some of that money off of the asset books according to the IRS. And so now you can have growth of money without having to pay tax on it because it grows non-taxable and it comes out tax-free. 3 main ways to use this. Number one is you can use it as college savings. A second way to use this is you can use it for if you're a business owner. Right? As an entrepreneur, we can put money in it, grow it non-taxable, access it tax-free. And there is a way to use this instrument in retirement, both as a retirement vehicle for long-term use or for somebody that's going into retirement and they have to do RMDs. They're able to move that RMD money into this tax-free index account, get growth on it, and pull money back out without having to pay tax on it again. Okay. On the inside of a tax-free index account or an index account, there is a feature called indexing. And I'm going to walk you through indexing or indexed accounts and how they work. I'm sharing with you the 3 or 4 pieces, and we're going to put them all together, and I'm going to give you an example of how one of these accounts work. But I want to offer you the ability to see on the inside about why it makes a difference. So the way indexing works is this. If this is your indexed account, and this is the stock market, and I'm going to use S&P 500 as an example today and show you how indexing works, fixed indexing. Does everybody know that sometimes the stock market loses money? Right? Yeah, it's a bad thing, but sometimes it loses money. So when a stock market loses money, for example, let's say it loses in 8%. Rule number 1 of an indexed account is that the money is not invested in the stock market. Therefore, it's sitting on the sideline and it doesn't go backwards. So you'd get a 0 that year. Indexed account, stock market. Second year, stock market loses money. Let's say it loses 7% that year. Indexed account, remember rule number 1, can't lose money, gets another 0. Are any of us excited about getting 0 returns on our money? Probably not. Until you're talking to a friend, you come to the FIBI event, you're talking to somebody like, I lost 7% last year, 8% the year before, I'm down 15%. And now I say, oh, I got 2 years in a row of 0. I'm kind of thinking 0 is my hero. Now that's called perspective.
Yeah.
When you don't lose.
Yes. I'm back on speaker again because we were all answering you from the room and you couldn't hear us.
Thank you. That's perfect. And that's why I did the hand motions. I saw some of those, so thank you very much. That's perfect. Okay, so year 3 in indexing, stock market goes up. And the way that an indexed account works is, let's say the stock market goes up 8%. The way an indexed account works is it shadows the market. It goes up with the market. So an indexed account is going to get +8. Year 4, stock market goes down. Let's say it loses 5%. Indexed account, the third rule of an indexed account is not only do you not lose principal, but you don't lose gains. So you're going to get another 0 that year. And then year 5, I call this the not too good to be true line. Let's say the stock market goes up 13%. The way that an indexed account or an indexed account annuity works is that year when the market goes up 13, the indexed account goes up 2, but it only gets some of the upside, not all of the upside. So in an example like that, the indexed account would get 9%. So here's what my clients say. Andre, I would be willing to give up that 4% to not lose 8, 7, and 5, which is minus 20%. This is called the power of 0. If you never have to lose money, and this is one of the things that makes index account annuities work, and it's also one of the things that makes tax-free indexed accounts or cash value or whole life insurance work. Because the company, we know at the company level, we're never going to have a down year, so we never have to make up for loss. Does this make sense to everybody? Is this, everybody's following the difference?
Yep. So far we've got yeses in the room. Yep.
I see that. Perfect. So in the index account, this is the basis of the instrument on the backside of what's happening internally. And there is another level of the watch I can take apart. I'm going to save that for later. I'm going to offer everybody here, I am willing to sit down or share at another time that detail of the class. I just don't want to overwhelm. I've learned the brain can only absorb what the butt can endure. And most butts are about 45-minute butts. So my intent is for you to leave today going, wow, I wish I had met this guy 20 years ago, because that's what I said. When I found this out and I started working on the numbers, I went back and I said, gee, I had $1,000 a month to save. I had $100,000. I could have been building one of these accounts, but nobody told me. And so 3 years into this, I made this decision. This was 7 years ago. I'm going to start teaching this around the United States. And it's been my payback, pay it forward to share this knowledge. So this is the principle of an indexed account within a whole life or a permanent life or a universal or index universal life insurance policy. Those are all under the heading of permanent life insurance as investment grade. This is also the principle behind an indexed account annuity. Making sense? Here's a little math piece I want to share because it always excites me. I had a client who came to my class and he said, Andre, okay, I get that this protects my money, but can you give me a real world example? And he said, I had $100,000 in the year 2000. He said, if I had met you and I put the same 100,000 in this indexed account annuity, what would it look like? And he asked me to do the math for 22 years. Today, I'm just going to do it for these 5 years just to show you the power of zero. That 100,000, after losing 8%, was 92,000. And then after losing another 7% was 85,000. And then when it gained this +8, it became 92,000. And then when it lost its 5, it was 88,000. And then when it got this 13% gain, it was at $99,000. So after 5 years, it was still at 99,000. The indexed account, it was 100,000, 100,000, 108,000, 108,000, 117,000. What always impresses me is in order for this account to match that 99,000, we need to get another plus 18% in order to get this account to be 117,000. So when I do this math, I'm now looking at 8 plus 13. So this would be 26, 30. This would be 39% gain in order to go from here to 117 because you lost money. If you didn't lose money, you got a 0, 0, and a gain, and a 0 and a gain, you only had 17%. Always fascinates me the math of money. A plus 17 beat a plus 39 because we didn't have to make up for loss. And I know it seems basic, but nobody ever talks to us like this. At least nobody ever talked to me like this. If you had this knowledge, high five. I didn't. So this is how the indexed account or the indexed account annuity works. Now let's talk about why life insurance can be and how it can be an investment grade item. Okay. When you and I go to a life insurance company, and by the way, when you meet the right person who says, I build these for the purpose of cash value growth, not for long-term death benefit, because you can do it both ways. It's an important statement. I want to build this for cash value growth. I want to build this for the purpose of being able to borrow money from myself. I want to build this for the purpose of arbitrage, and I want to build this for the purpose of tax sheltering. I don't want to build this just to have a big giant death benefit, because you can do both. So I'm going to give you an example. I have a client and they came to me and they said, Andre, I have $500,000. And what I'd like to do is I'd like to grow that money. I'd like to have access to the money. And then I'd like to not have to pay tax on it again. And I've heard that there's a way to do that with cash value life insurance. So let me show you the inside. Let me show you how this would work. So this $500,000, the first thing we have to do is go to the life insurance and ask them, we need an umbrella of life insurance. This umbrella is what makes it work. This umbrella does this. It gives you a 0% floor. It gives you indexed growth. It gives you access to that money. It makes it a non-visible asset, which means the only people that know about it are you, your spouse, or your partner, and if you're using it to show on your books. But it doesn't show up for tax purposes. And all of the growth that happens on this $500,000, there's 3 components to this account. Number one, We've got a self-completing retirement plan. That's a really nice way to say death benefit. So that death benefit, day one, would be $1.35 million. By the way, every account is age-based. This, my friend here, is a 45-year-old man. This number will fluctuate a little bit, just as little bit detail. And by the way, this isn't too detailed for you all, is it?
No,
Okay.
we're all good.
Good. So this gets a $1.35 million death benefit. Here's how the life insurance looks at that, or here's how some of my accountants will look at that. They say, Andre, if I started with $500,000 and day one, if I died, I have $1.35 million, that's a 250% return on my money on paper. That makes sense?
Yes.
Kind of neat. Now, that's not why we bought it. We're not buying it for the death benefit. But the IRS says, in order for this all to work, you have to have this life insurance umbrella. And so what I said to the software is, I want the smallest life insurance umbrella for this amount of money. The second thing that this account does is it creates what we call living benefits. There's, in today's life insurance world, there's the old kind of life insurance, which you have to die to get the money. And there's a new kind of life insurance called living benefits life insurance. And what living benefits life insurance does, very simply, is the company says, hey, if you have a life event, like a heart attack, a stroke, cancer, cognitive impairment, ALS, blindness, or a long-term care event, if you have an event that you could have died from, but you lived through it, we will give you access to 75% of this. That means you now have access to up to $1 million. So here's my example. 11 years ago, I'm just a couple years after my wife and I deciding we're not going to be married. I'm a new half-time dad with 4 kids. We got rid of our house that we built in Breckenridge, Colorado. I went out of business as a franchise store owner. I'm $50,000 in debt going, oh my gosh, I'm a single dad. If something happens to me, where do I get the money to pay for it? This instrument, that's one of the pieces it offers, is it says, if I had this, I have access to this up to $1 million for this heart attack, stroke, cancer, long-term care event. So there's this medical piece that there's only 10 of 900 companies in America that do it this way. Some companies will say they do it, but they don't give you full access to here. Okay, so those are the 2 extras, those are bonuses that come with the account. Let's talk about the money inside. We call this the indexed account. So the indexed account, when this 500,000 goes into the account, a part of that money obviously has to pay for premium. And I love this question. There's a question out there. I have some cohorts, some counterparts in the stock market who are like, why would you want to buy life insurance with your investment money? And that is a fabulous question. And I say to them, why do I have to pay you a management fee? I am not anti-stock market. I am not anti-stock broker. But one of the things I did as a business owner, as an entrepreneur, I said, let's compare your management fee, 2% for the next 30 years, to what I'm actually going to pay for the life insurance in this account. So make a note. One of the pieces of knowledge as you build this account, and so if you're going to talk to a life insurance person and you're going to talk to them about this, here's a question you want to know. When or what year does the $500,000 that you deposit, when does this account, because when you make this deposit, part of the money goes into pay for life insurance and the rest of the money is going into the indexed account and growing. So a very important question. If you sat with me, you will not leave sitting with me without me showing you and doing all the math to show you when this account breaks even. So as an example, This account here, this 500,000 at year 5, I think I want to do it here. At year 5, this account has a balance of $511,000. I call that break even. And here's the question. If I have as much money in this account as I put in, did you really pay for life insurance? And my stockbrokers guys go, oh. And they're like, I'm out. And not that it's bad, but here's the other side. Wait a minute, Andre, I put 500,000. How come I only have 511? Part of it is that the IRS, if I deposit all 500,000 at once, it actually buys a $7 million life insurance death benefit. But in order for me to get you a $1.35 million death benefit, I actually have to do this 500, 100,000, 100,000, 100,000, 100,000. I have to do it over 5 years because I'm trying to get you this 1.35 million so you don't pay as much for life insurance. Does that make sense?
You're minimizing the management fee.
I'm minimizing the management fee. I'm minimizing the cost of life insurance. My point is this. The IRS says, Andre, you can put all 500,000 in the first year. But if you do it, you will have to pay tax on the gains later. So if the goal, which is where I'm headed right now, is to talk about how this account is a non-taxable account, how we're going to use it for arbitrage, I don't want to put all 500,000 in the first year. I want to do 100,000, 100,000, 100,000. So that's why this 511, it's not 500,000 that grew over 5 years only to 511. It's actually 100,000 and then 100,000 and 100,000. So my growth got spread out. The second thing the life insurance company does is they say, look, the way we make money is we want to sit on your money. And so we have a surrender charge schedule. And what we're going to do is we're going to defer that surrender charge. And as long as you keep your contract, we're going to waive it completely. But in those early years, we're not going to give you access to all of the money. There's a little detail in here, and I don't want to go too far down that road, but I want to point it out because again, it's a question you want to ask when you're building this policy. Okay, so here's the exciting stuff. Thank you for letting me show you the pieces. I see the different, I feel the different levels of like, wait, I want that detail, I want that detail. So now we've got this index account. Here's what's really cool. The life insurance company does this, and I'm going to use 5 years as the example. You can access the money after the first 12 months. So that is one of the rules. When you deposit your first 100,000, the company says, hey, wait until the end of the first year. And at the end of the first year, you could access $90,000. I'm sorry, $55,000 of the money. So one of the things they do is they don't give you an access to all of it the first year. So part of the scheduling piece here is, how do I use this as a bank? Let's use year 5 as an example. I've put this 500,000 in, I have 511,000, and here's where arbitrage happens. On this side, where we have the investment, this $511,000, if I look back right now at the last 5 years, this account has earned 9.7% actual every year for the last 5 years. If you want to compare that to the stock market, those same 5 years has had an average return of 16%, which is an actual of more like 13. So it's about a 5% difference. But here's what happens. You've got 511,000. The way we use it is an investment grade account is your money investment is growing at 9.7. The math on that would be $49,000. So you'd make $49,000 that year on this account. And then Napoleon gets a call from a friend who says, hey, I got this property. Or Lynn gets a call. Lynn, I'm after 400,000. And yeah, I know the hard money rate's 9%. I'll pay you 10. Lynn's like, hold on one sec. Andre, Do I got 400? No, you have 511. Okay, I just want to borrow 400. And what the company does is from the other side of the company, from their cash reserves. Oh, by the way, did I tell you that the reason that all of this works is that when you and I deposit this $500,000 with the life insurance company, the government requires us as a life insurance company to have $530,000 minimum liquid money. We're never allowed to be upside down. We bailed out the IRS, government, and banks in 1929 when the Great Depression happened, because we were liquid, right? We have more money, we have enough money to buy and sell the oil industry 7 times. So here's what happens. You got this 511, you earned 9% last year, you made 49,000. Lynn says, hey, I want to borrow $400,000. The rate right now is 4%, and it usually is prime +1. So when I log into my account, I borrowed some money last year to do a property, it was 4%. And you ready for this? I had a piece of paper, I put my name, my account number, I told it how much I wanted, I signed it, I emailed it. 4 days later, the money was in my account. No hoops, no income verifications, no, let me see last 2 years of tax returns, let me have your grandmother, your father, your brother, your sister, and your cousin sign for it, and oh, I want a title on all 7 of your properties. This is essentially your money. This is, I think Napoleon said, bank on yourself, or somebody in the room said, bank on yourself. This is where the idea comes from. So now you borrow $400,000, you're borrowing at 4%. So what is that? 16,000. So you have 16,000 of interest on the loan side. You have 49,000 on the growth side. If I do 9.7 versus 4, that means you had an arbitrage of 5.7%. All of your principal is still growing. You borrow at 4%, and so your money, your net is 5.7 for the year. And then Lynn tells me, well, actually, I hard money loaned it for 10. So I made 10% on the hard money loan. I paid 4, so Lynn made 6 on the hard money loan, and actually made 9.7 because the 5.7 got paid by the 4. Does that make sense to everybody? Did you all follow what I did?
Yeah, no questions in the room? Yep, we're good.
You heads. This is why the wealthy went to the tax people and said, hey, we want to create an account. We want to create an account that is non-taxable in growth. It's, oh, do you all know why it's tax-free in access? Because in the United States, taking a loan is not considered income. So here's a long-term play. Some of my clients, I'll give you an example. I have a doctor. He makes $1.5 million a year. And he said, Andre, do you know about 7702? I said, I'm a veritable expert, as a matter of fact. I said, because I'm going to treat your money like it's my money. And he said, Andre, I'm already at the highest tax rate possible. He says, what really frustrates me is when I put my money in the market, and every time I make money, I have to pay tax again. And because I'm at such a high tax rate, I'm paying this high tax rate. So by depositing a substantial amount of money into this account, he's allowing himself to get the growth on that money. And we built his account. He said, Andre, what I would like to do is 7 years from now, I want to be able to pull out $200,000 a year as a loan. So we're in the process of stuffing $700,000 a year into this account. We're going to do it for 5 years. We're going to let it grow for a couple of extra. And then he has the ability to pull $200,000 out as a loan, which is tax-free. So it doesn't affect his income. And as he said it to me, he says, I want to get to the point where I lower the level of working as a doctor. Now, as a real estate investor, this is an amazing place to put some money, some profit, grow it, and then be able to turn around and access it, use it back. This just happens to be the example, right? It's the other side of the understanding the money piece is every now and then I have a client who comes to me and says, I really want to give you $5,000 a year to do this. And what happens is that for a 45-year-old, $5,000 a year isn't going to give him the kind of access that he wants, simply because of the life insurance is a predetermined amount for a 45-year-old. So one of the things that we want to look at is how do we maximize, how do we lowest umbrella maximize the money? Let's say we didn't borrow any money, just to give you a little piece down the road. If we didn't borrow any money out of this account at year 10, it has $640,000 in the account. And at year 20, it has $1.2 million in the account. Now, little disclosure, I'm only allowed in a public setting to run an illustration for you at 5.2%. So all this math that I'm doing here about growth is based on a very conservative 5.2%. Even though all of my spreadsheets and all of my illustrations from the company, show that it's 9% for the last 5 years and 7% for the last 7.9 for the last 10 years, 7.5 for the last 15 years. But we're not allowed to. In the 80s, a group got really excited and they got people to mortgage their houses and put money in this. And they said, we're going to get you 18% a year. And they did once. But in the year 2, when it got 3, in year 5, when they didn't get what they said. And so it didn't work the way they had illustrated. So the government has said, whoa, you're only allowed to illustrate at these very conservative rates. So I want to share that, because that is a question that comes up in my brain. It's like, wait, okay, that's that. Pieces there, pieces there, pieces there. Okay. This is when we put the life insurance umbrella on it. Questions on any of this piece? Anybody need any clarification? Does anybody have? Christina, is it okay if I ask that?
Yeah, absolutely. Yeah, it's important that you guys ask questions at this point. So if you got a question, Lynn, go ahead. And
Yes.
Napoleon, put it in the chat. Anybody in the room?
Yes.
Okay, you can be next after. We got Lynn first, then Napoleon, then D here in the room.
Perfect.
Okay, I wanted to know, so you're talking about with your illustration of adding money for 5 years. Is this something that you have to keep paying the premiums over like a 10, 20, 30-year period? Or is it something that you just pay 5 years and then you're paid up on the policy? Like, I'm not really sure.
Great question.
What are the requirements in terms of the continued payment into the policy?
5 years is the sweet spot. When anybody comes to me with a pile of money, my overly engineering side has run the illustration every which way from here to Tucson to Australia. And what the math shows is that we take the pile and we divide it by 5. It gives you the optimal growth with the least amount of life insurance premium with the smallest umbrella. That's a long way to say 5 years would be the minimum amount of a consistent amount to get the best and most advantageous use of the policy. Now, with that said, yes, I have clients who say, Andre, the money I will have is X for 7 years, or 10 years, or 20 years. Whole life policies, when they were born, so whole life is the Model T Ford. And then after whole life, they converted to what's called universal life. Whole life is a dividend-based instrument. Universal life is a fixed instrument, and that would be like a carburetor or fuel-injected car. Indexed universal life, where we're actually giving you the abilities to make up to 14% on your money in a year, would be the electric Tesla, Rivian, some of the other vehicles that are out there. So when we build it, it has the flexibility does not have a requirement, but it has the flexibility to be a 5-year, a 7-year, a 10-year, a 20-year policy. So it does depend on your money, your situation when you want to do it. And I'm always going after optimum. I'm putting myself in the seat, knowing what I know to go, what's the best way to grow it with the least amount of money, with the smallest life insurance to get you the best access at certain years. With that said, every single one of my clients has been fully customized, fully based on them. I'm building 2 accounts right now for a 6-year-old and a 3-year-old. And I have the grandfather and the father combined. We're going to put $57,000 a year in for the first 5 years. And then we're going to do $30,000 a year for the next 15. And it all has to do with, we're using the gift. I always want to say the word tax, but we're using the gifting ability in the US to be able to move money into an adolescent's account tax-free for each of those generations. So again, it's another place that I understand the money. Lynn, was that good? Cool. And I'd love to, and I'm totally willing. I'm a no fee-based advisor. What that means is I never charge anybody a management fee, because my company, or companies, because I represent about 30, they will pay me a one-time commission if you decide to do business. So what that means in my world is I get paid on performance. I get paid because I showed up and I made it work. And whether that's 2, 3, 5, 7 meetings down the road, I want you to understand. Versus there are some people that will sell this on a fee-based model. I made a decision not to. It feels better for me. Napoleon, you want me to do Napoleon?
I'm going to jump in here for a minute, Andre.
Yes,
I can
please.
personally vouch for that. Andre has worked with a client of mine. I think you met with this person 7 times. So he will show up as many times as you need him to show up. That's how he earned the street cred to be on my podcast and in this meeting. It's been watching him work with a client of mine.
Thank
All right,
you.
go ahead. Move on.
Napoleon says, how much are the premiums? I have built this at $100 a month. Here's an example. A baby. If I do $83 a month for a baby, which is $1,000 a year, and we do that for 60 years, it's $1 million. So 60,000 in becomes $1 million because of compound interest and non-taxable growth. And I think, Napoleon, I feel like your brain's going, wait. The premium is based on how much money you're putting in and how old you are, because there is a component of life insurance. So the better vintage we are, the little more the life insurance is going to cost. So when I build this, like if this client was 75, we could still do the same 500,000. We'd probably have a $600,000 life insurance umbrella. And the money would be just a little bit less because we're paying a little more for life insurance. Does that make sense, Napoleon? Cool. The second question is, I'm still lost in the management fees, putting money in the, okay, cool. So Napoleon says, I'm lost on the management fees versus the life insurance. Example, can I erase this? Would everybody be okay with that?
Hold on. No.
Okay.
He's like, no, you can't erase it. No.
So let me answer the question without erasing it. Napoleon, I look at whatever you're going to pay for life insurance. I just compare that as though you were paying a management fee to be with a broker in the market. And so if the life insurance is, let's say that I put this $100,000 in, and the life insurance has a cost that year of, let's say, $10,000 of the 100,000, I look at that like a management fee, because that's not only 90,000 of your money's growth. Does that make sense? And so then what I do is I go and I do the math 3, 5, 10 years, and I want to do a comparison of what that looked like. And what I know is if you put 500,000 in and you have 500,000 at year 5, well, the life insurance was free. Maybe you and I, Napoleon, do a little detail into that. I actually have a whole piece to work out. There was a question in the room that I heard you say.
Yes. Okay. So one of my questions is this. Let's say, and I just want to make sure if I understood this right from something that I heard about this. And so I want to just have you clarify this. Let's say
Thank you.
someone takes out that $400,000 loan and they die.
Yes.
Do they have, from my understanding, they do not have to pay it back. So what happens is when they die, the family would get that less what? 400,000
Awesome.
less what?
A great question. One of the reasons that this policy works is the life insurance company knows that there is a $1.35 million death benefit that will get paid because we all die and pay taxes. So the answer to the question is, because this is a permanent life insurance policy, the life insurance company knows, hey, we got this 1.35 coming at some point. So if you borrow 400,000 and you die, we will simply subtract 400 from the 1.35. So the
Okay.
family would get $950,000.
Okay, I just wanted to make sure that's something that I heard, so I wanted to just make sure that was correct. Another
Yes,
thing too is the acronym for SCRP. Did you say that's self-completing retirement plan?
self-completing retirement plan. That's
Okay.
that's homebrewed.
That's what?
It's homegrown. I made it up. Actually, I borrowed it from one of my trainers. She said it in a meeting once. I'm like, that's brilliant. It's a death benefit, but it's a self-completing retirement plan. So if I
And
have this,
oh, I'm sorry. I'm going to let you finish. Sorry.
if I have this account, if I died, I'm going to leave 1.35 million, which means that whoever I leave it to, my retirement follows them.
Got it. And then my next question is, so for someone like, let's just say I'm 43. So, someone in their 40s, what would be like, a monthly amount that you would recommend at that age? Or yearly amount. I'm sorry, yearly.
Yeah, that's a great question. I have learned that the starting point, there's two starting points. One, what feels good to you without stressing you out financially. Because anytime somebody says, oh, you should do this much, but it stresses you out financially, that stress actually follows your money and it follows your life. So one, don't create stress with that amount of money. The second side of that is, think about a Roth IRA. Today in the US, Roth IRA, the maximum that we're all allowed to put into it is $6,000 or $7,000, depending on our age. That's a really great starting point. So when I sit with my client, I build this two ways. One, I ask the question, what are you used to saving? How much have you been doing? What's your habit already? Great starting point. The other way to ask the question is, how much do you want at what age? This doctor, he said, Andre, my goal is for this to pay me $200,000 a year tax-free at year 7. And I'm like, awesome. All right, we need to put 700,000 in for 5 years. So he's going to make a little over $3 million of deposits. And at 40, he's 42 now, and at 49, he'll be able to withdraw $237,968 per year tax-free for the rest of his life.
Crazy.
Because there's a dude at the top of the ivory tower. It might be a girl, a gal, a woman, a person. There's a person, top of the ivory tower, short tie, pocket protector, glasses, white tape. Who does the math? It's the actuary. And they know, based on our 173-year history of building these accounts, they know what the market's done, and they know what they can do, and they know what they can do on a guaranteed basis, and they know what they can do on an index basis. The reason I'm only allowed to illustrate 5.2 is because we want to underpromise and overdeliver. So then the second answer to the question would be is, how much would you either like to put in, or what would you like that goal number to be? And then sometimes we started at a couple hundred, and then it's a couple thousand, and then it's 10,000. After the crash of 08, my goal was, how do I get back to having $1 million in savings? And so for me at 40, I needed to put $625 a month into the account for 40 years, and I'd have $1 million. What's happened is my income every year keeps going up, and so I keep maxing that, and I've had to build 2 more of these accounts, because one of the things I do is I build them so that they get, the piggy banks only can be so big, and then you have to build another one or expand the piggy. So it's kind of a loaded, not a loaded answer, but a customizable answer on what your goals are. And it does start with what's comfortable for you.
Got it. So you're saying you could start at, let's just say $20,000 a year. I'm just throwing that out there. And then you can even make that 30 the following year if you want.
Yes.
You could add more to it. It doesn't have to be set at 20 for the year.
That's correct.
Okay. Thank you for answering my questions.
My pleasure. Has the flexibility. Ellen asked the question. She says, I have no children, so the life insurance aspect is not necessary for me. What is the advantage to this over regular investing or saving? Ellen, number one, the first advantage is having the life insurance umbrella is a requirement by the IRS in order to get non-taxable growth. So we're not buying the life insurance for the life insurance, we're buying it so your money will grow non-taxable. And we're buying the life insurance so it will come out tax-free. And we're buying the life insurance so that you can get 0%, so you can get index growth, and you can get non-visible asset. With that said, second part, the death benefit, not as big of a deal, but the death benefit is a function of this living benefit. I have a lot of clients who they say, look, I don't have kids, or they say, I do have kids, but I don't want to be a burden to my kids or my family. And so they look past the death benefit and they say, Andre, this living benefits, this access to $1 million, is it really important to me? Because I can buy an account now, and if I have a heart attack, I can dip into this. If I have a stroke, I can dip into this. If I have a cancer, I can dip into this. If I have ALS, blindness, lose a limb, lose an organ, coma, 3rd-degree burn, I can dip into it. If I have a long-term care event, I can dip into this. So it is a question of, are those important? Because they're not important to everybody, but sometimes they are. And this neat example, I have a client, I'm gonna use this example, she had some cash sitting in the CD, sitting in the bank. She's like, I just don't want to lose this. What's the purpose of it? She goes, if I need it, if something happens. Well, the day we put it in, it became 1.35 million, and we doubled her money. So I turned her 500,000 into $1 million of critical care, medical care, if something happened, if she needed it for that purpose. So that there is a way to do that. And the other thing is this. Sometimes people really, really don't need the life insurance, or they can't get the life insurance. So here's what we do. We take the life insurance umbrella off the account. And what happens is we eliminate the tax-free access. So we can still have an indexed account annuity, and it still grows the same way. It still has the protection. It still indexes. It still has access, and it has a living benefits payout where you can access that money usually twice as fast of what's in there. So there is if I switch that gear just a little bit, that's where, when we talked about investment grade life insurance and annuity, and again, fixed index annuity, not variable annuity. I hope that helps.
Okay, Elin, are you done? Because she had 2 questions, which was she wanted to understand something else. So check the chat.
Oh, I see it now. I'm not sure on the tax-free part. At a certain point, I can withdraw the gains without taxes. Yes. Or is it a loan against the policy? Thank you for the clarification. So when we have this money in the index account, when you take the money out, you actually have a choice. You could say, you know what, I just want to pull principal. And I want to just, as I pull principal, the whole account shrinks. All right, you could say, I want principal, which means your death benefit would go down, your living benefit would go down if you decided, I want principal out. It's doable. We'll run the math when it comes to that time. But I'm going to show you the math on, or you could take a loan out. One of the things that we do internally on this account is we say, we will pay you a guaranteed loan amount every year until you die, because we have a death benefit and we have cash value. And so what happens is it becomes a question of, do you need more money faster? Like, do I want to take all 1.2 million out right now and be done because I'm moving out of the country and I just want all the cash? Or would I rather take, you know, a $90,000 a year payment tax-free every year until you die? Recognize that a $90,000 payment out is the equivalent of about 140 from a stock market account or from an investment account that you pay tax on the gain. If you're in a tax bracket of, let's just say 25%, and you get to pull this money out tax-free, that means I'm saving you 25% per year. If any of you have an investment or know of an investment where I can get 25% a year on my money with no risk and no loss, please call me. And I do say it to be funny, but it's one of those things that my head exploded. And when I sit down with the stockbroker who wants to say, you know, because when we have the conversation and I go, well, I can pull out tax-free, that means I'm saving my client 25%. Stockbroker's like, okay, I'm out. Because that's not their model, right? Most investing in the stock market is let me grow your money. There's not always a conversation of preservation, access. And here's a question. Does anybody think taxes are going up or down in the future? I would agree with all of you.
There's a lot of ups in the room.
Yes. And that's what's really cool about this, because even if taxes do increase, all this money comes out tax-free. You know, and these are the account, you know, like our politicians have these accounts. Our presidents have these accounts. Bernanke has these accounts. Buffett has these accounts. Right. It may not be where all of their money is, but it's a chunk, it's a portion because of all of the pieces that are there.
Okay, so I have one last question from the room, and then we need to wrap it up just because otherwise people can't get food.
I understand.
Here, I'm gonna let you ask the question. Go on.
Hey, how you doing, sir?
I'm awesome.
Is it people with retirements account, can they set this plan up?
When you say retirement to me, my brain goes to IRA, 401k.
Yes.
Is that what you mean?
Yes.
Okay. Question. This hypothetical person, are they over 59 and a half?
No.
Okay. So here's what I want to say. Yes, absolutely, you can set this up. However, the government requires that only post-tax money goes into this account. What that means is there's a conversation. If you take your money out of your 401k or your IRA, you're going to have to pay tax. If you're under 60, you're going to pay a penalty of 10%. So there's a mathematical question of, based on those expenses, and do we put it in here, does this still make sense? So strictly speaking, yes, absolutely. But depending on your situation and the age and how long it's going to sit and how long it's going to make up, there's a conversation here about maybe we don't do the life insurance umbrella. Maybe we take the life insurance umbrella off, because an indexed account annuity, you can just do a rollover of an IRA or a 401k with no taxes and no penalty.
Mm.
So it's a little longer conversation, strictly saying you can do it, but it does have to definitely be done in a way where you understand the tax implication.
Yes.
Because you have $500,000 in your 401k, you pull it all out and you stick it in here. Next April, the IRS is like, hello, you're my favorite person. Here's your 45% tax bill because you took $500,000 out. I just don't want you to be surprised by that.
Would it be easier if they switched it to a self-directed?
Same situation.
Okay.
All IRAs, 401ks, self-directed, SEPs, 403bs, 457s, and Roths. Not Roth, take that out. All of those accounts are considered pre-tax accounts, and the IRS says you can't touch them until 59 and a half.
Thank you.
I have a presentation or a little class around 401ks were awesome in the 70s. Today, we're at the lowest tax environment we've ever lived in. I know it doesn't feel like it, but because taxes could go up in the future, a 401k is a very slippery slope.
All right,
Unless you're getting
so, all
free money.
right, guys, let's give him a hand.